Welcome everybody again to this monthly series. We are very happy to have Ricardo Reis. Needs no introduction, but I'll give one anyway. He is the A.W. Phillips Chair of Macroeconomics at the London School of Economics. And to anybody who's paid attention to anything in central banking over the last 20 years, he has written a lot of very influential material. And today he is going to speak to us about inflation disasters. Now, he has told me in advance that partly apologized that this is not specifically a communication paper, but I have assured him that if you think about central bank communication, you are thinking a lot about inflation and inflation disasters at the moment. So we look forward to everything you have to say, Ricardo. In general, the way we do this is we sort of give you the floor. If there's anything that's really like a two-hander, we may intervene, but generally you'll have the floor for, let's say, about 45 minutes, and then we'll jump in with questions, and we'll take questions from the comments, and I'll sort of read them out to you, so you don't have to try and monitor those.
Okay.
But otherwise, over to you, Ricardo.
Great. No, thank you so much for giving me the opportunity to present to this crowd. As Michael said, when Michael first asked me to give this talk, I thought, oh, but I'm a great consumer of the inflation communication literature. I consume it so avidly that I could probably write a survey of what I think we've learned and haven't learned. But then again, especially for this audience, there will likely be other people who are not just avid consumers, but also producers, and would do a better job at doing that than myself. So instead, I told Michael I couldn't, but he was very persistent and insistent. I said, okay, then I'll just give you my last paper, Inflation Expectations, and that's what I'm going to do. Hopefully, you'll find it interesting. It's very much of a paper that straddles macro and finance. It's a paper that we put out a first draft less than a month ago, and then, but I guess what in software we'd call a version beta without the appendix all done, and with some of the numbers, some samples finishing a little earlier, some later. And what I'm going to give to you today is actually the final version of the paper, which should be up on my website next week. This also comes with a website that's going to be updating these every month now that we have all the programs running and solid, and they're going to be running every month. So that's what I'm going to do. You can find a draft on my website. There'll be a much better draft next week, as well as monthly updates of the series that I'm going to produce. So join work with Jens Hilscher and Alon Raviv, with whom for almost a decade we've been looking at inflation options data and doing kinds of interesting things with them. What is this paper and this presentation about? This picture here is the five-year expected inflation for the US and the eurozone. How do you build this? It's very easy. You pick up a 10-year expected inflation, say for instance subtracting the interest rate on a nominal bond from the interest rate on a real bond or an index bond. So you get a measure of expected inflation, sometimes known as break-even inflation. Do the same for the 5-year. Remember that insofar as inflation is a change in logs, then 10-year inflation is nothing but 5-year inflation plus 5-year inflation. So subtract the 10 minus the 5, and you get the 5-year. That's it. Now, this picture is very easy to build. It is very carefully monitored by policymakers. I believe there's at least a few in the audience, and this picture has to be updated on the daily basis to make sure that the expected longer inflation it uncovers isn't behaving in some strange way. And why is that? Because look, ultimately, if you're an inflation targeting central bank, there's always reasons why inflation may be too high or too low right now, and shocks. It may be optimal, certainly under a flexible inflation targeting regime, to have a deviate from your 2% target for 1, 2, 3, even 4 years. But if you look at an after 5-year horizon, if your target is 2%, you better think that the markets, not to mention the people and the firms, expect inflation to be 2%. That is ultimately, this is a measure of your credibility, of your success. Now, this is never exactly 2%, partly because this has a risk premium embedded. And secondly, it fluctuates over time, maybe perhaps because of high frequency noise in financial markets, or such that you wouldn't expect this to be a truly horizontal line or two. But even then, when you have a period like happened in the eurozone, where around the middle of 2014, this decisively fell and stayed low from then onwards, or all the way until the pandemic, this was one of the major inputs to justify why the ECB had to engage in quantitative easing, and more generally, do policy that worried about about the risk that DCB was no longer hitting a 2% target, but rather something below 2%. What I want to do is I would love a picture like this so that I can assess the credibility of the central bank, so I can assess to what extent the longer inflation anchor where it is. But I don't want it at the expected. I'd love to have the tails. Why? Because robust decision-making cares as much about the average as it cares about the tails. Because in my models, the models I write, the tails are as much or more about the cost of inflation than the actual expected average value. So I would like to have a measure of this for the tails. However, that is not easy. And this entire 40 minutes is going to be about how to build that, how to construct a tail measure, which if it's even just 5% as influential as this expected measure, then this paper will be perhaps one of my most successful ones, if it turns out, given how often you see this picture updated and how many people's jobs is to produce this picture. So to be clear, I want to produce to you an estimate of what is the current date market perceived probability that inflation is going to be persistently or below an annual target between a long horizon and an even longer horizon. For example, and to be much more specific, what is currently, and I'm going to do this monthly, every month, the probability that, and again, what is probability that average inflation will be above 4% between 2027 and 2032 on average. Why 4%? Well, first of all, this is a disaster. I mean, this would be 2% high inflation for 5 years on average. So that's a 10 log point deviation from the target of ECB or of the Federal Reserve. So that's a lot. Why not much more? Well, because ultimately I want to use the options data. I can do this for the 5% and I will show you. But then when I try to do it for a sample of 10 years, often there just wasn't that many people buying insurance against this event. So I can't build it. Although right now I could build a 5% very easily. And indeed, I'll show you some numbers of that. Okay? But that's what I'm going to produce, a probability of either high or low disaster inflation, understood as that. And the contribution is going to be how to use inflation options data. But importantly, if all you do is go and read from the data using standard techniques of the ones that you would learn in an advanced finance course on derivatives pricing, I will show you, and perhaps this is a more economically interesting point, that is wrong. Okay, you need to adjust the data, and that's going to matter quantitatively a lot. When you see, and you've probably seen inflation derivatives data being used to produce distributions, I've done it myself in previous work. When you're looking at, as I'm going to show you, 1 year ahead inflation around the expectation, the median or the mode of distribution, you're doing it wrong, but it's okay, because quantitatively it doesn't matter. But when you're looking at the tails at a long distance horizon, you're way off doing it. And I'm going to show you why you're doing it wrong. Okay. And then I'm going to have some complementary, which is aside from the actual probabilities, the risk neutral ones or risk adjusted, also over near horizons. And I'm going to use this, even though it's very much going to be 20 minutes of methods of how to do it. Then I'm going to use it to reevaluate some interesting bits about inflation history of the last 10 years. So let me tell you right away our method. And especially what are these three adjustments? So this is, if you want, the more conceptual part of what this paper does. Let me start with an extremely simple example. Again, we're going to do this in great generality, too much generality. But before I lose you all with notation, a very simple example of what I'm trying to do. Imagine inflation today is some normal value, target value pi. And with super high probability, we're going to stay there next period. So PM and PD are both close to zero if you want. However, there's some probability, let's call it PM, a small number, I don't know, 5, 10%, something, where inflation rises to a moderately high level. And with a PD probability, inflation rises to a disaster level. Imagine this inflation over the next currently, and this is over the next 10 years or 5 years, okay? I want to estimate PD, the probability of a disaster of inflation. Here's what I have. I have an option. That option pays £1 if there's a disaster in period 1, and it sells today for AD pounds. D for the disaster, 1 for the fact that it's about something that happens in period 1. Okay? What is the price of that option? Well, the price of that option is that, well, with probability D, it pays off £1. Well, but £1 in real consumption units, you have to divide by inflation, or the exponent of inflation. Inflation here is in logs. And then you have to multiply by the marginal utility of consumption at that future date, which I'm going to call MD, the marginal utility of consumption in the disaster state. Okay. With probability 1 minus PD, this option pays you 0. And so that's why that is the price of that option. Now, you realize, though, that if I bought an option that paid a D state, if I paid an option that paid at the M state or at the normal state, well, then de facto I would have bought the risk-free rate, meaning I would have gotten £1 for sure next period. And so what you have is that the adding up, if you wanted the price of these three options and multiplying by the nominal interest rate, you would get exactly 1. Therefore, you can build something called a risk-neutral probability, N, which is nothing but multiply the price of the option by the nominal interest rate, and then note that this adds up to 1 and is always non-negative. And therefore, something that's non-negative and adds up to 1 is a probability, and therefore these are very famously known as the risk-neutral, or this is how you would build the nominal probabilities for inflation to be in the disaster. Okay, so that's, I think, this is the standard thing people do. Let me tell you why this is wrong for this problem, or what are the issues with it. First, an Arrow-Debreu security does not pay $1 in the disaster state. An Arrow-Debreu security pays 1 unit of consumption in the disaster state. The price of an Arrow-Debreu security, therefore, is equal to, or the probability associated with it, is equal to the same PD, the same MD, but has none of this adjustment factor. And moreover, it is multiplied by R, the real interest rate. Oh, this is a typo, sorry. This should be exponent of R, not R. So this should be exponent of R. Yes. This probability, this is not what people tend to do in the literature, but actually what the textbooks say is a risk neutral probability. Why is this a risk neutral probability? Because if you are risk neutral, if agents buying options were risk neutral, then all the M's would be equal to 1. Okay. And or not M's equal to 1, sorry. All the M's would be the same across states. Richard Child says marginal consumption is the same across states. And therefore, they would be equal to exactly the inverse of the real interest rate. So these two terms would be equal to 1. And as a result, when you read off the Q's, you're really reading the disaster probability. That's why we call these risk-neutral probabilities, okay? Are these the probabilities that you will read off, I don't know, the Minneapolis Fed website if you go there right now? No, Q is not N. By elementary, middle school, GCSE level math, algebra, look at this expression and this expression, Q is equal to N times this. Well, but what's R minus I? Well, that's break-even inflation, as I already told you. Let's say that break-even inflation is equal to the target inflation pi, because we're in normal times, say. Well, then what is this? This is nothing but the size of the disaster. Okay. What does that mean? If your horizon is short, say 1 year, okay, and you're calculating the probability of a disaster being, I don't know, inflation goes from 2 to 5%. That says that when you're reading off that probability out of what Bloomberg will report for you, you are wrong by a factor of 1.03. Well, duh, you thought probably was 10%. It's not. It's 10.3%. Not sure I care very much. But if you're looking 10 years ahead at a disaster of 3%, then the adjustment factor is exponent of 10 times 1.03. It is a much larger. Your 10% probability is really off. You should be saying 13.5% probability, or in the other direction, 0.67 probability. What is the intuition of this adjustment? It's very simple. When an option pays you, it pays you in nominal units, because that's how options are. They pay you pounds or dollars. But in the disaster state, which is when the option pays, that dollar is worth less. Therefore, the option is cheaper, is worth less, because yes, it's a great option. It's going to pay you when very bad things happen to inflation. Well, but when it pays you, that dollar it pays you is worth a lot less. That's why its price is lower, and that's why you are understating the probability if you ignore this adjustment factor. I know it seems like an almost point. It's one of these points that I'm still stunned that the literature had never noticed that. Okay. Second point, familiar one, which is yes, but even if you use the right QD, you now have to deal with the fact this is a risk neutral probability. You have to adjust for this MD, the disaster risk adjustment. But here, another point, another insight, if you want, which is look, if you are looking at disasters, if you're trying to measure what is the marginal utility for different realization of inflation, oh boy, you have 30 years of literature to catch up on models of affine term structure, risk premium adjustment, of all the 72 things that could drive inflation risk premium. That's tough, okay? But there's some people who are very good at it. Maybe some of them are in the audience. Well done. I've read what you've done. It's quite impressive. I can't quite do that. I just don't have the brain power for it. But for my problem, it is actually much simpler because I don't care about the inflation risk premium when inflation is 2.3% or 1.6%. All I want to know is the inflation risk premium when inflation is really high in a disaster. In other words, it's only when the probability of the disaster happens, okay? Or sorry, it's only for the probable disaster that happens. I want to adjust that for the fact that there's going to be, at the times in which there's an inflation disaster, when is it that you have an inflation disaster? So let me call P the conditional probability that you have an output disaster, conditional inflation disaster. And it's only when I have an output disaster, inflation disaster, that I need to adjust for risk, that I need to figure out what the marginal utility of consumption is then relative to all the other states. But then I am in this easier setup that people over the last 15 years in the equity literature have exploited or explored, starting with the work of Robert Barrow, which is all I need to measure is really a disaster. What is the disaster probability and the disaster adjustment that is the output drop in that inflation disaster? I don't need the entire risk premium. But then I can do, and that's what I'm going to do, completely copy, free ride, stand on the shoulders of giants, and do exactly what the literature on output disaster does, but apply it to the conditional distribution of output inflation disasters to figure out what that adjustment is. Third adjustment is allow me to introduce a third date. Why? So that I have, this is now, this is the next 5 years, and this is the 5 to 10 year horizon that I really cared about, okay? Note, if I want a disaster here, note that there are 3 possible ways we get there. Maybe we jumped, maybe first we went to moderate inflation and then hit disaster inflation. That is the most likely event insofar as you often hit disasters right away. Maybe you hit the disaster right away and stay there, or maybe you stayed in low inflation or target inflation and then jump to disaster. I think it's reasonable, at least most people have studied inflation, to say that inflation, even when it jumps up, it jumps so gradually. And as a result, that this term is really the larger one relative to these two, because PD isn't twice as large. But then what that means is that if you calculate in PD as opposed to PD2, what I care about, the 5-year, as opposed to the 5-year, then the 5-year is going to understate the 5-year. Intuitively, if you look at the 5-year, you understate it because the more likely is rather that inflation is not a disaster in the next 5 years, but then jumps to a disaster. Likewise, if you look at the 10-year probability, you're understating it because that's if you stay in a disaster for 10 years in a row. But that's just one of the ways into which you get to disaster later on. Okay. So what you have to realize that for the 5-year, you have to do an adjustment for this persistence. But how do you do that? Well, what you really need is some forward dated option that tells you a model of persistence. Knowing that, I'm going to estimate that, particularly realizing that the same options and using only options data, you can figure out what is this persistent rise in inflation and how it comes from the stochastic parts of inflation. But you have to do the adjustment because if you look at either the 5 or the 10-year probability, you are going to be potentially severely understating the 5-year. Okay, so let me manage my time. Let me now show you just a few, well, I'll show you some results, but this is a scary slide. It only means one thing. I do not care for my exercises. It is not relevant, the fact that there's a lot of uncertainty in the world. Only inflation risk is relevant, only inflation variability, okay? Then, as I told you, I'm going to be able to extract from the options, and if I do what everyone else does, you get the wrong number. Those nominal probabilities are only actual probabilities if de facto there is no inflation or inflation is completely known, because as soon as inflation deviates from target, you need to do that adjustment for real units that I told you before. But let me just skip that to say that you can use the option prices to, and it's not very hard. You'll basically get an option price. You figure out how the option price varies with strike prices. and that allows you to recover this Q probability as long as you do the right adjustment for the inflation and the real interest rate. What I'm going to do is I'm going to use data on options. Bloomberg reports these data on what the prices of options on inflation were for the US and the eurozone. I'm going to do this from essentially the start of 2010 until we just updated this for the data for the middle of first half of the month, March 2022. And as I told you, we'll be updating this month. What you need to do is you need to get this options data. What we have done, you can do this daily. You can do this daily, every day, calculate probability. We have been very conservative. This data is noisy, like other data is noisy. You may worry about exactly how many people are trading these options on a daily basis. Nowadays, by the way, a lot of people are trading them, but still, you will be conservative. So what I'm going to do is we are going to collect all the prices across a lot of days, all the quotes we find, and then using like a whole week, we then throw out all the data that violates any kind of, even by epsilon, arbitrage condition. We then, from that, pick up only the one that violates nothing, average smooth out over a couple of days, and therefore we produce a monthly estimate of this. We think this is just perhaps hyper-conservative on our part, but at least we're very confident that this is the right number for that month. Okay? Let me then show you right away what these distributions look. Note, all I've done is my first adjustment. So this is the 10-year. It's the proper risk neutral, but it neither adjusts for risk premium nor does it adjust for the horizon. So neither you get the 5-year, nor for actual probabilities as opposed to risk neutral probabilities. But still, kind of pretty cool, because here's some of these distributions starting in 2011 all the way to pre-pandemic. Very interesting thing is, leaving the financial crisis, and a lot of people don't remember, but back then, there was a lot of uncertainty on inflation. We could have ended up with high inflation or low inflation. There had been a jerking up and down of inflation in 2008 and 9 and 10. And so as a result, these distributions were somewhat spread out. It is quite striking how the Fed did an amazing job, if you want, and again, using these to measure how well the Fed has done insofar as anchoring around its target, of how you go from this spread distribution to a distribution that was very concentrated, very around 2.3. Again, many estimates of inflation risk premiums said that risk premiums are about 30 basis points. So this is roughly at the inflation target. Not a lot of variability, almost all of the mass between 1 and 3%. Okay? Remarkable successful re-anchoring, essentially the success of the Fed over the last 10 years, pre-pandemic, at anchoring inflation expectations. In the eurozone, interesting application. Around 2013 and 14, you had this shift from the blue to the red line, or the curve, I'm sorry. And this was what again led to the birth of QE, the anchor to low inflation in the eurozone, which had to do with a clear shift in market expectations that inflation was going to be lower in the eurozone, with a complete elimination of the right tail, and the starting of a lot of mass being around the 1 to 1.5 percentage point, very concentrated in the 0 to 1, 0 to 1.5. Okay. Moreover, the deflation probability rising and rising here. Okay. Note that then QE came, the 2014-2016, it didn't work insofar as a clear anchoring there, this was the state of the eurozone, the difficulties we faced from 2016-2020, and if a distribution that was clearly anchored to the left of the Fed and with seeming more of a left tail. Okay. But what happened during the pandemic? I guess you guys care about the pandemic. Here is where we start in 2020, blue line. Here is a year later after pandemic, nothing much. If anything, yeah, very little, maybe a little expectation of a little more inflation and so on over the next 10 years. But then, first 6 months of the year, distribution starts shifting to the right. Added another 5 months, distribution shift to the right, and a lot of mass showing up in the tail. Look at 1 week ago, there's a distribution. Again, this is average inflation for the next 10 years. The mode is now solidly above 3%. And look at the mass on the right tail here. It's really quite striking. Okay. The Fed's change in policy in the last 3 months don't seem to have altered the market's perceptions of a potential high inflation. What about the eurozone? The draft of the paper you have on my website has these first 3 or these first 4, and it says, look, similar to the US, but much less. But then the last 3 months are dramatic. dramatic shift also in the eurozone. In 3 months, seems to have caught up to almost all of the shift in the US. So huge changes. Okay, first adjustment, that's what I did. And again, if you were doing without our adjustment, you would have severely understated these things here around the right tail. Second point, second adjustment, the risk adjustment. How are we going to do this? Look, I need a model of inflation consumption. They're covariance to adjust for risk. So here is the most general model I could write. There's normal inflation, and then there's shocks to inflation that are uncorrelated with shocks to consumption. These can have jumps, volatility, whatever you want, okay? But then there are normal shocks to inflation that are correlated with shocks to consumption. And then there's the disasters to inflation, the high and low disasters, which may be correlated again with potentially consumption disasters as well. The important thing to understand is that, and then shocks to inflation and to consumption that are uncorrelated are irrelevant. The correlation, the beta zero correlation between the normal movements, this is the literature on inflation risk premium, not my business. My business is this beta H and beta L. If I figure these out, then I'll know how to adjust for risk. Well, for these, let me do what the inflation is, the output disaster, equity disaster literature does, which is say that the size of these disasters follows a Pareto distribution. Okay, I'm going to allow the Pareto distribution to be different, whether it's a positive inflation disaster or negative, so that all I need to do then is to measure the thickness of that tail as well as the minimum size of the jumps. And to do so, I'm going to merge the Barrow consumption data for 140 years with the Jordan-Schulrich-Taylor inflation data for 140 years. And I'm going to look at how often do I find an inflation disaster using the simpler methods, which is, hey, let's look over the last 20, 30 years. Let's do a bandpass filter. Look at what was the average inflation in the last 30 years. If inflation in a 5-year window is more than 2 standard deviations or 1 standard deviation above that average, I say there's been an inflation disaster. And that allows me to calculate for all these countries, Australia, Belgium, Canada, all the way to the US, when was there an inflation disaster, which I plotted for you here. These are either high inflation or deflation disasters. One observation, there's been a lot of inflation disasters. A lot of these, by the way, are deflation disasters. Then you have the 1930s deflation of the US and the 1920s high inflation of Germany and many other places. You have the high inflation of the 70s, and then a few disasters around 2010, 11 in terms of deflation associated with a crisis. Okay. Importantly, the probability of an output disaster, conditional inflation disaster, is only 20%. Why? There's a lot of deflation disasters here that are just fine. Economy sometimes going to deflation. So what? It's not deflation. Hey, Japan has been in deflation for 20 years. Output has been pretty good, actually, output per worker in the last 10 years or 15 years. It's not, a deflation disaster is not correspond one-to-one to an output disaster. Second, when you estimate the Pareto distribution on the size of the output losses during those inflation disasters, you end up with some estimates of the thickness of the tail and the minimum jump, which are kind of in line with the literature on the output disasters. But importantly, you see a very big difference when you do this for the low inflation disasters or the high inflation disasters. Namely, low inflation disasters have a much thinner tail than the high inflation disasters. Why? Because actually, often you end up with deflation that doesn't, very often deflation comes with a little bit of an output loss, but not some massive output loss. As a result, when you calculate risk premium using this method, what you end up with is that the risk premium on high inflation is significant, something like 0.5%. You need to add 0.5% of inflation to an estimate of 2% inflation to get the risk premium and therefore get 2.5. This is quite large. The literature is tending to estimate some numbers around 20 to 40 basis points. But at the same time, deflation risk premium is actually pretty small. At most, some 10 basis points or not. Okay? Why? Not all inflation disasters are output disasters, and those disasters lead to output disasters mostly with deflation, not so much high inflation. Finally, to adjust for the horizon, again, in the interest of time, just to tell you that I'm going to use this model of inflation. But again, what I care about is when do I enter a disaster? And to do that, given that I only want to use options data because I want to see what is the perception of the markets and to be consistent with those probabilities, What I'm going to do is basically use the fact that the options comes in bins of what inflation is going to be from -1 to +5%. And then I'm going to use the fact that on top of the 0.5 and the 0.10 inflation distributions, in the data, there are also year-on-year inflation distributions. There's options on what is inflation between 2026 and 2027, between 27, 28, between 28 and 29. Now, those distributions are often discarded because there's definitely a lot less volume of them and they're much less liquid. But, and here was our insight, when I looked at the distributions, that is pictures like the one I showed distributions, for the inflation in 5 years, in 6 years, in 7, 8, and 9 years, for the 1 year ahead, what we noticed was they're all very, very similar. What that says is that the market traders, maybe they're crazy, but they are the market traders, seem to believe that after 5 years, we've roughly reached the annual ergodic distribution of annual inflation. But that means that I can pool these 5 years, have a lot of data, average out whatever noise they have, and have one forward distribution. And with one forward distribution, I can then estimate the Markov chain of how inflation moves across these states. And I'm going to skip the details exactly of how that is, but just to tell you that the key thing is the probability of how do you jump to a low deflation disaster, a high inflation disaster, or a measure of the stochastic volatility of inflation. Here are our US parameter estimates. You see a clear fall in stochastic volatility of inflation. And for these jumps of just a 1 year potential disaster, you see clear movements over time, okay? With a recent rise in the jump, understandably. And for the eurozone, the difference is that we find strong inversion, again, a fall in stochastic volatility, but we see a lot of variation in this jump to deflation, perhaps corresponding in the seminar on communication to changes in communication of pulse by the ECB. But how am I doing? I'm doing great. Okay, so I have 10 minutes to get to the probably what most people in the audience really want to hear about, which is I've shown you the method, I've done these adjustments. I've shown you the dirty thing under the hood. You have to estimate a Markov model to the horizontal adjustment. You estimate an inflation disasters model to join with an output disasters model, a joint disasters model to get those probabilities. And I showed you how I did it. You build the stuff from the data. So now let me do revisionist economic history of inflation in the US and the Eurozone using my estimates. First revisionist history. There were papers back in the early 2010s. There was a lot of concern that the US would fall into a deflation trap. The liquidity trap literature was getting pretty hot. Policymakers were talking about it. Some of the early papers using inflation options, very influential, good papers, were trying to use inflation options precisely to measure probabilities of deflation. Okay. However, now with our new methods, we can do a much better job than that literature did. We can revisit to what extent there was a legitimate fear of deflation in the 5 year horizon. People are looking at 1 year only. But the literature was, of course, a lot about a trap of deflation. What was the risk that the US would be stuck in a deflation trap? This is blue is the probability of deflation. Red is what we call serious deflation. That is for a disaster of -1% on average inflation over the 5 year horizon, the 5 year horizon. And what we find is that actually this was one, yes, it rose, but it peaked at 14%. And very quickly in 2012, it was essentially gone. From even the end of 2012 onwards, this deflation probability, and I stopped here in 2014 so that you could better see this one, it basically never exceeds 5% for the entire sample, okay? The Fed had very aggressive policy at this point to fight the fear of deflation. A lot of maybe justifications of very loose policy in 2010s was to avoid being like Japan. According to our estimates, there was never, at least in the market perceived, never a very high perceived probability of deflation, actually, at all. Conclusion number one, these deflation fears weren't really there. Why? Why did other people find different things? Because if you're not doing the risk adjustment and you're looking at just 1 year ahead, then you end up in dealing probabilities of 40, 30, 20%. Why? Because basically what markets were telling you was that the probability that we'd end up in deflation 1 year was pretty high during these 5 years, during the beginning of the decade. You could have when inflation was very stable around 1.5%, 2%, sure, you could end up with a shock that led you to inflation going below zero. But a deflation trap, which is what policymakers were talking about. Nobody who said, oh, we're worried about deflation for 1 year. That was much, 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 much lower. And so whether you look at the 10-year on average or the 5-year like us, we end up with much smaller numbers. Why also? Not just the 1 year, but also the fact that you have that risk adjustment I told you, and our 33% reduction also because of the horizon adjustment. All of those tell you that actually there wasn't much of a deflation probability, which I don't know. There's only a few for people in this literature. I think this is a quite different result than others have found before. But what about the eurozone? Turns out that in the eurozone, not so. And this is again, I don't know. To me, who followed this, I was very stunned by this picture. Remember, the ECB has spent this whole period over here fighting deflation risk. And if you look at the probability that we're going to get deflation on average over the next 5 years, the ECB succeeded. After that increase that spooked out Mario Draghi in 2014-15, indeed, the ECB has succeeded to keep that deflation probability below 5% throughout this period. But if you look at the 5-year, the blue line, you see that the deflation trap possibility is there. The ECB won the battle insofar as both Draghi and Lagarde avoided deflation being a scenario during their watch. But markets never seem to believe that the probability that fundamentally the institution of the ECB could lead to a deflation trap would have disappeared. Those continue to be there throughout. Okay? So that's my second conclusion. The ECB was able to avoid deflation over the last few years, but that was never a structural institutional success. This, if you want, may be used as justification for the ECB review of its mission a year ago. Something had to be done because institutions seem to keep a high probability of a deflation trap being possible. Third, what about the pandemic? Everyone wants to hear a pandemic, okay? Third conclusion, this is revisionist history, it's more present history. What is the probability of an inflation disaster with the pandemic? Initially, not much. Starting in 2021, you start seeing some action in the US, and especially starting around the summer, that probably starts rising and rising and rising and rising and rising to the point where by March, our revised estimates, it is around 15%. In a sense, this is shockingly high. This is again, if you use this as policymakers have often done when giving speeches in the last 10 years, as essentially a measure of whether you're doing a good job, whether you're credible, this says there's a 15% probability that the Federal Reserve does not have a credible policy now. People think that inflation, Fed is either going to lose its independence or is going to allow to a 1970s type inflation. Very interesting, the eurozone. So in the draft of my paper in my website right now, the sample ended here. And I said, oh, kind of interesting, nothing yet in the eurozone. And yet, once you add January, February, March, there is a dramatic jump of that probability in the eurozone to still be half of what it is relative to the US, but still at, again, 8%. So in the eurozone now, whereas up until just 4 months ago, there was no sign of a loss of credibility to the ECB in avoiding a high inflation scenario. Now there is, and a very clear one. Okay, and that's brand new. You're the first ones to see this picture, guys, in the seminar since we just finished this 2 days ago. And it's very surprising. I mean, I feel a little embarrassed because there's some ECB governors gave speeches a month ago saying, oh, according to our estimates, the ECB is doing great. Oops, sorry, 3 more data points. It's not doing so good anymore. My apologies. I guess that's research. Moreover, though, another part of it is that note how, if instead of the 5-year, here's just if you just do the 10 and the 5-year. So no horizon adjustment, but doing the right nominal real adjustment and doing the risk premium adjustment. Very interesting how both in the eurozone and in the US, you have the same phenomenon of the 5-year being higher than the 10-year. I.e., indeed, markets are saying, I expect higher inflation in the next 5 years than in the following ones. But, so it's not, the 5-year probability is at 30%. The 5-year, guys, is at 15%. So the markets are really expecting a very high probability potentially of inflation over the next few years, and then something like 30%, and then an equally very high probability, but not as high, half as high, that it persists over 10 years, that we go all the way there. So, sorry, thanks. But to conclude, because I think, I have 2 minutes, this was a presentation on how to calculate a counterpart to the five-year figure that all central banks spend so much energy on. But let's focus on the tails, because I don't know, the tails are really what, as a robust decision maker, as a risk manager, you probably want to care about. What are to what extent are markets perceiving you to potentially lose complete control of your anchor? It's natural to use options to measure tails. As some of you know, I've done a lot of work on expectation surveys. And there's other people who've done even more work and better work. This is a question that's very hard to answer with surveys, tail probability. Surveys are very good for the average, and how to figure out what the expected outcome is. And even if you look at second, third moments, like I've argued, in terms of distribution of those, but still not to ask people about what do you think is the probability of a tail event is quite hard. Options are very natural, but we need to develop some machinery. We did that. As I told you, we're going to be doing this every month since there's a lot of interest in these numbers. Here are my 4 conclusions for more in the economics. The deflation fears in the US were quite exaggerated. At most, deflation would have happened for a year, according to the perceptions of these traders. Second, the ECB, though, is still stuck in a deflation risk trap. It's quite striking, even though it succeeded in lowering the probability of a deflation in the near future, not in the more distant future. Surprisingly little improvement. Maybe it is the change in regime we'll see of a year ago that has improved things. In 2021, the Fed has a very significant drip, and the ECB, it's really in 2022, in the last 2 months, we see a very large increase in these probabilities. That's what I had, and let me stop here.
Perfect. Thank you very much, Ricardo, and perfect on time, but also for all of us who have seen you present many times. It was your typical tour de force. And I think speak for all of us and say that we're all very excited, those of us particularly working on communication, for the data to go up on your website. A reminder to the general audience that if you have questions, put them in the Q&A box, and we'll make sure we ask them if the time allows. But Rafet has raised his hand, and so I'm going to first of all call on him, although I have a few questions that I want to ask as well. So I'll start with Rafet.
So thank you, and let me echo Michael that this was, as expected, wonderful. So one thing that immediately comes to mind when somebody says, "Oh, I have market-based measures of inflation," something, even if you were doing this with things like tips, is liquidity and liquidity pricing. And in this case, it isn't quite good enough that liquidity in the options are high, right? Because your machinery requires not the option for the average, but option for the tail to be liquid. And in particular, since this is a forward, the 5-year option and the 10-year option at the tails having similar liquidities and liquidity pricing, which is rarely the case. And that liquidity pricing is fairly variable over time, right? So I guess my comment is that there is some reason to think a little bit about how much of this over time changes we observe might be due to both the absolute amount of liquidity in these options and the changing price of liquidity for these things.
Right. So exactly as you noted, so I mean, in some sense, you've answered the question already, meaning I won't be able to do better than what you said, which is liquidity is always an issue with any financial instrument. I told you we were trying to be very conservative in joining many of them, insofar as we weren't as ambitious as trying to use daily, because day to day, you may think that liquidity could drive a lot of these things. But what I mean by you almost answered, Rafet, is that note that it's not enough for there to be a liquidity premium in these things, because what it has to be is that it's a differential liquidity between the 10-year and the 5-year, right? So it has to be some differential liquidity between the two, one. Two, note that it has to be that you think the liquidity. Note that I focused very much on how these changes have changed over time, as opposed to necessarily their level per se. So it has to be that it changes over time in a way that distorts it. And thirdly, Rafet, I was even more conservative. Note that, and I was tempted, but I didn't do it. It would have been, I could have looked at these pictures and say, and I really want to do this, Rafet. I want to say, wow, it's a communication seminar. Remember what happened in 16, month 9? This is why this jumped up. This is why this jumped down, and write a paper about that. But instead, I was very conservative. And I told you, I'm just going to see the fact that this is high. When I looked at this, it went up. Why did it go up in 2021? 6 versus 4. It went up. It's around 15%. I was purposely sloppy, not telling you it's 14.2%. It's around 15, a little bit above or not. Let me focus on the trend, because I was trying to guard against that exactly. So I'm looking at trends only changes over time. It's about the differential 10 and 5. All of these to guard against trying to seem as one can measure this too accurately with too much precision, because precisely there's issue with these prices moving for, again, liquidity premium or just market disruptions of whatever time. So this is what I've done.
Very true.
The next step is just to give up.
Let me make a quick point.
Huh?
Well, actually, I mean, one thing you can do, which is fairly cheap, is take these measures and regress them on option bid-ask spreads for the 5-year and the 10-year, and the long-staff trick of looking at the REFCO spread, right? Yeah. And that's a measure of the price of risk, perhaps. And if these things come up insignificant, that's a strong statement. And if they're significant, that's a mechanism for
exactly. I can do that. But again, what I would say, imagine that I regressed it and the correlation was very high. They would say, look, when it's up and down, it's because of that. But insofar as I'm like, look, it went up, and how important it is that it went up, that wouldn't still undermine the fact that it just goes up, unless there was unless there was a trend in the bid-ask spread. I guess what I'm trying to say, as opposed to the month-to-month variation. So it's beyond the regression. Finally, for the privilege of the rest of the audience, note that a little bit of words on who's trading these options. I mean, this is the people who are trading in these options are a lot of life insurance and pension funds who really are exposed to this big risk of the 5 and the 10-year horizon. And so there's actually quite a bit of volume in these two contracts. One, and two, and again, Rafet alluded to this already, this in many ways is the market where you go and buy a little bit of insurance when you're trading 5 and 10-year bonds, either nominal or real, right? So insofar as, and this is my cheap answer, I gave you good kind of solid, modest academic answers. Let me give you the cheap answer, which is, hey, if you like looking at this picture, why don't you like mine? I mean, the same guys trading on this with the same liquidity problems for this are the guys on my options. To a first approximation, it's just the guys buying insurance at the tails. And so there's a sense in which I'm not doing much worse than that. But I think that's a cheap answer, like saying that, well, I'm as bad as this one. This is not, I think, a good answer. But I gave it anyway.
Okay, I'm going to ask Michael Ehrman, and then I'll ask Catherine Mann to ask a question, and I'll come in at the end if there's no more that come in.
Thanks a lot. Yeah, Ricardo, this was a fantastic talk, very, very fascinating, amazing tool. And indeed, I'm sure this will be monitored quite actively across all central banks. I have one question about sort of the very end of the sample. I mean, you called your slides pandemic, slide 31 or so. But I mean, we now including March, which is not only pandemic, but there's also war, right? Which, very immediately and noticeably was felt in inflation data in Europe. Real-time correction here. So in some sense, I was surprised to see that in March, the eurozone line doesn't jump up more. So is this only the 5-year, meaning that markets perceive that, this is going to be over within a year or two? Or, where do you see some, I presume you see some big effects here exactly. I mean, you have this at the very end.
Yeah, no, you're right. Look, first of all, the March numbers here, Michael, to be clear, these are for the first 2 weeks of March, right? So they're already 3 weeks old. So this is beginning of the Russian invasion.
I see. Okay.
So this is, first, not even second, I think it's first week of March. Again, we do some checks on the data, as I told you. So we use some of the data from the second week, but it's first week. So yeah, we're going to be releasing these like on April 15, 20th, because we use always the first week of the month data, and we always use the second week just to check to make sure there was some nice. So that's the first point on that. Second is, you're right, though. I guess I hadn't paid attention to that. The bigger jump, though, comes exactly in those first 2 weeks relative to February. If you look at the 5-year only, right? But when you look at the 5-year, and you adjust with our method, you don't get quite as much. Some of the jump had already happened before. So there's something here insofar as you were saying, I think a probability of a high inflation that's short-lived goes up way more than a persistent inflation, according to our estimates. And the reason why you see why is you see the 5 jumps a lot, jumps way more than the 10. So our estimates say, well, the 5-year, here at most of the jump had happened already in the previous 2 months, which is when there's a big discrepancy between the 5 and the 10. So yes, no, absolutely. There's some effect here of March, subject to, again, being the first week of March, which probably, may be related to the war in Ukraine. Yeah. Let me leave it.
I guess we're anxious to see the April data coming in here.
That's right. Yes.
So I hope you'll have your website up by then.
Well, absolutely. Yeah. No, absolutely. We're having it up next week. Sorry, I had COVID the last week, so that's why I wasn't able. I wanted to advertise the website in this talk, but oops, that got delayed. But by Monday, hopefully, it should be up.
Perfect. Catherine, do you want to unmute yourself and ask your question?
Hi there. Always a very interesting project. And so I have sort of 2 questions. One follows a little bit on what Rafiq was saying about using the financial market pricing as a fundamental input and how comfortable we are with that. And the observation that I would add to his commentary about liquidity is to question sort of the horizon of financial market participants. You mentioned it was life insurance and pension funds and so forth, but although they have long-term liabilities, they trade very short-term. So I'm not 100% sure how that might be relevant when you're thinking about so far into the future, because you do have episodes where even those long-term liability holders are trading and hurting in the short term along with everybody else in the financial markets. And I wonder whether that type of observation is why you're getting such choppiness in particularly the Fed's line here, the blue one that we see here, so that you're sort of overemphasize your market underpinnings because they have short-term time horizons for their trading activities, even if they have long-term horizons for their liabilities, and that's what they're hedging against. In the short term, they're trading along with the same low, very high frequency as everybody else. That's why you're getting with these big, these really pretty choppy estimates of anchoring and de-anchoring, particularly for the Fed. So that's my first sort of observation question. The second one, though, is if I compare your unadjusted, exactly this chart, we're working together here, Ricardo. If you compare this chart, which you say is wrong, there is a flattening out or even a tipping down of the long run expected inflation. And so, you're basically saying this chart is wrong. And in fact, this right way, which you have at the other end, is showing an increasing probability of what I would call de-anchoring, but we could call it whatever you want. And so I guess I understand all of the changes that you've made, and I appreciate that they are right. But I wonder over the time horizon of central bank decision making, which is, monetary policy has its effects over a 18-month or 24-month horizon or whatever, that these 2 charts really are telling me so much different things that I need to undertake your apparatus on a regular basis.
Okay, so let me answer 2 things that I think are useful, Catherine. The first one is on the short. First one, note that I just realized I forgot to. This ends in January, so I'm missing here the February, March just for this picture. Sorry, because this one isn't with my data. This is just a standard one you could get from Fred, but I forgot to update it. So that's just a note. Second, but more importantly, you mentioned the fact that some of our estimates of probabilities are choppy, and I was going to note that's why I came here. Sure, so are the 5-year. There's a lot of movements here, and precise for the reasons you said. I mean, this is traders. We know that there's noise in financial markets. Whether we want to call them liquidity premium, horizon changes, just the fact that markets are noisy. These things, as I said, one wants to carefully monitor them, but definitely one does not want to, as a policymaker, to overreact to day-to-day changes in this. At the same time, when the changes turn out to be persistent, that becomes important. And that's what this figure is, not all that much smoother or less choppy than the one I showed you that had only a year and a half, whereas this one has 10 years. I plot my figures over 10 years, like I guess I had some like on the deflation ones. Over 10 years, it's equally choppy or unchoppy. As you notice here are my probabilities. Oh, it's a 5-year. I have one. Oh, here's one over 5 years. I guess I never pictured one over 10 years. So anyway, so on the choppiness, you're completely correct. But at the same time, these things do seem to move significantly with important trends, which I think contains certainly some signal that's useful. Second, and perhaps more importantly, I think I confused you a little bit here. There's nothing wrong with this picture. This is a risk neutral probability, not risk neutral expected inflation. You may say, well, but I don't like risk neutral. I want adjustment for risk. So you want to subtract some risk premium. You can do that, but hey, that by itself may not be a huge thing. Let's leave it at that. So there's nothing wrong with this. Beyond, again, this risk, I would not use the word wrong to describe looking at something risk neutral as opposed to adjusting for risk premium, okay? What I said was that if you were to instead produce probabilities, and I never showed you those because I don't like showing wrong things in papers. If you were to, in presentations, if you were to show the probabilities that come out from reading a Bloomberg terminal, which is what I call you these ND1s. And so if you went there to the bank and you asked one person on the staff, I even know the person you would ask, go and tell me what the probability of inflation being above 4% on average over the next 10 years. And they say, well, my Bloomberg terminal allows me to pretty much, I get 3 option prices. I'll even show you the formula. They would plug it into this formula and boom, you have it. That would be wrong for the 3 adjustments that I made, okay? And those are consequential, they matter. But to be clear, you may not want to do my 3 adjustments, Catherine. Meaning, and I try to show you that, for instance, you say, I don't really trust your 10-year, 5-year changes. Fine, let me just show you the 10 and the 5, so you don't have to buy my horizon adjustment. I don't really buy neither that, Ricardo. I also don't buy your risk adjustments. Then just look at these. Don't go, because these are defensible. These are over a 10-year risk adjusted, so including risk premium, but you're calculating them right. I wouldn't go as far as calculating what I call the wrong one. These are the Qs. I wouldn't calculate the Ns, even if I want to calculate the Ps, okay? And for these ones, yeah, look at this. Let's look at the US ones. I don't know, not to focus on the eurozone too much.
I like these. I like these
right?
a whole lot. To me,
so
this is what I look at, right? This is the more important.
Okay,
this
fine. So again, these do not do my horizon adjustment or my risk adjustment. They just read the Bloomberg, but use the right formula. So this is what I meant. Like, these are right. And the ones that you could have done would have been wrong because of that interest rate adjustment things. And on these ones, what you see is they have kept on shifting right. You called the plateau. So let's look here at November versus March, Catherine, for the US. It's true that the shift November to March is smaller than the shift June to November in the mode, right? Again, I don't have the explanation there. But note also, what are you seeing in my numbers? My numbers are really the probability of these tails, right? It's the above 4%. You see here that even though there's look at the difference between green and orange and the I guess, other green. No plateauing here. It keeps on going, right? So that's just, again, look just at this picture, if nothing else. Have someone at the bank produce this picture for you using the right formula, though, not the wrong formula. And then, yeah, I'm getting bigger numbers once I do the 5-year and the risk adjustments because of the change in risk premium that I'm getting and this horizon difference. But if not, this is at least, you can read the same results from here. But yeah, I'm trying to show in the paper, in the presentation, if you don't like my second and third adjustment, the horizon adjustment, you can still read everything off out of here. That's fine. Again, I like these ones. I think those are better, but there's nothing wrong about any of the other ones, just to be clear. Okay? But what there is a big difference is looking at tail probabilities versus expectations. That's just Those are just fundamentally different things, right? And I need to convince you to make it having worthwhile the last hour of your time, that it's important to look at tail probabilities, not just at expectations, not just at mean outcomes.
Okay, Ricardo, I'm going to ask one, and then I'm gonna bring Petra Geritz in. We often overshoot. We eat into a sort of 15-minute burn if you're okay to stay. So I will do that. So I had a couple of comments. One thing that so I have set in my diary an alarm for Monday morning to check your websites, not to put pressure on you, but you know, one thing I think people certainly on this call, maybe on this webinar, may be tempted to do is to do a little bit of what you did, but also what you tried to avoid doing, which is saying, okay, it was this speech here or this shift in policy that does this. But it raised a question in my mind, which I'd love to get your response on. And that is, you know, in our models, the ones we write down, you know, it's typically the case that standard models with particular setups to make them easy have certainty equivalence. And so this chart that you've left on screen is the right thing for me to worry about as a policymaker. Now you've seen my work on this that tries to think about the risk and uncertainty aspects of policy. You have your own work that talked about Greenspan with Adam Blinder and the insurance management type approach to monetary policy. So is that what we should take a little bit from some of what you said? You know, the discussion about QE in the euro area or even QE in the US as being motivated by policy being, maybe I should have asked Catherine this question about what she would be worried about as a policymaker, but the idea was that it was exactly this worry about, well, I guess the eurozone had this thing trending down, which was a more stark one, but in the US, if we go back to QE times, it wasn't like expectations were dropping like a stone, but it was clear that the policy was about avoiding deflation. So without having seen your proper distributions, do you think they were heuristically learning this, or it was from market intelligence? Were they doing risk management in their policy? And is there something sort of missing in our models then when we think about optimal policy?
Okay, so on the first beginning of the question, which is the month to month, I think, you know, again, I was, I don't know if modest or scared was in this paper to do too much of the month-to-month estimates, and that's why I was just looking at the trends. But, you know, I hope that the way research normally evolves is that people will pick up my estimates. They will point all the ways in which one could do much better. They will improve them. They will especially deal with the liquidity issues. And then, yes, use month-to-month and do event studies with them and so on with potentially improved estimates. Remember, Rafet is going to be a referee and he's going to ask you about liquidity, so make sure you do a good job about that. I don't think I've done a good job about it, which is why I'm not doing it. But that's just why you need to write a new paper, not just copy my numbers and, you know, run some regressions. You know, you need to work a little harder, I think, to do the month-to-month things. So that's on that. But I definitely want to encourage people to do that. Maybe I'll do that. But at least for now, I'm not planning to it. But I hope other people pick up my estimates, improve them, show what's wrong about them, and are able to do the month-to-month, I think, more solid than I thought I could. On what you said, absolutely. This paper is very much motivated by robust decision maker. If you are central certainty equivalence, linearized models, nothing of what I showed you is particularly interesting. Everything that I talked about when I did my revisionist economic history of inflation monetary policy was all about, if you're a risk manager looking at the tails, then you would have done QE. Oh, you would have changed. You'd have done emission review at ECB. Oh, maybe you shouldn't have worried as much about deflation. So 100% agree with what you're saying. And that's definitely the entire spirit of the whole paper, and why you need to go through all of this work and pain to do it. You asked, though, do policymakers do that? I think my impression is, and, you know, a few policymakers in the audience, but certainly from reading what many of them have written, I think all policymakers look beyond certainty equivalence. They definitely worry about tail scenarios, and they worry a lot about risk management with regard to these tail scenarios. And so I hope, therefore, that these kind of numbers that I'm producing will be, as I said, bold at the beginning. I hope they'll be very, almost, you know, not as useful as these ones, but at least 10% as useful as these ones. I think they would still be very, very useful, because policymakers absolutely have to care about that. In this particular question, Michael, especially so, right? Because if we're talking about the anchoring of long-run inflation expectations by the market, subject to all their short-term noise and all of their liquidity issues and whatnot. Still, if we're talking about a central bank that is an inflation targeting independent central bank, which has in its mandate the main job in the long run, that's my five-year emphasis of horizon, that's that long run, your job is to keep this around too. I would think that you worry a lot about the tail risk where this is not true, where you've lost. And why? Because in my view, these probabilities that I've calculated, wherever they are now, these high probabilities, these are, if you think there's a 50% chance the market thinks that the Fed is not going to hit its 2% inflation target to 2027, 2032 in a persistent way, I think these are really probabilities of A, the Fed is no longer going to be independent, B, the Fed is no longer going to have a 2% inflation target, C, the Fed may be independent, may still have 2% inflation target, but really is doing a bad job at it for 5 years in a row, right? And packing these three is obviously first order, but very, very hard. But seeing these numbers should at least give you some pause and tell you we need to reestablish our credibility. Credibility is a very all-encompassing term, but I think this is a very particular diagnosis of your credibility, is the credibility of not just you as a policymaker. In fact, Jay Powell is not going to be in charge this horizon, I think. I mean, well, maybe it'll last as long as Greenspan, but in expectation, he won't be there 27, 32. But it's really about the credibility of the framework of the independence of the central bank that I think is at stake here. And that's being measured here by these markets participants. Yes, and tying it to communication, if you think, no, we are doing a good job, then you really need to be communicating better with the markets, because the markets are kind of having, because what these things are saying is the markets are ultimately these numbers, guys, another interpretation of them is how expensive is it to insure against this fact? And people are now paying a little bit of money to insure against it.
Yeah. Okay. Good. Yeah, so I agree with all that. It's particularly interesting actually when you looked at the distributions, the ones that Catherine said she did like the average inflation targeting announcement really you would have hoped would sort of tighten this distribution around an inflation target, and it doesn't seem to have at least yet done that. But anyway,
on the other hand, to be more positive, look at 2010. It's beautiful, huh?
No.
Very successful policy making.
Yeah, no, I agreed. Petra, I'm going to give you the last question, and then we will wrap this up.
Yeah, okay, thanks. So I really like the comparison of the two central banks, and I was wondering whether you also got data for the UK, because the Bank of England already started policy rate and quantitative tightening a few months ago. So it would be interesting to see whether that has kind of like allayed some of the inflation disaster risk concerns that you show for the US and the euro area. And I think it would also be very interesting in terms of further analysis to see how these inflation disaster probabilities relate to the realizations of inflation. Because when we look at inflation expectations, even far ahead, they tend to be quite highly correlated with actual realizations of inflation. It would be interesting to see whether it's similar for your inflation disaster risks.
Right. So on the UK, the data exists. It's a lot of work cleaning these data, because, partly just because, and I'll blame my co-authors in part because they're very careful and very nervous about getting it exactly right. And so we actually take a lot of time to clean this whenever we do these things. But yeah, the data exists. It's just an issue of time, manpower, research budget, if you want, to kind of have a few research assistants collect all the data, do all the cleaning, all the checks, and then crank it through our machinery. So no reason why not to do it. We've looked at Japanese data. That one, the data just seems too noisy at these tails to really get anything. But in the UK, there is something there. It seems like it's perfectly feasible to do it. I just haven't done it. I haven't had the manpower to do it. On comparing this with actuals, I think, again, we're estimating here tail probabilities. The right comparison here then would be looking at precisely tail events for actual realized inflation. There you suffer, Petra, from the limitation that you can only start this in 2010. The market inflation options only starts around 2005-06, and only by 2010 is liquid enough. But of course, over 12 years, you don't have that many inflation disasters, although maybe the president will change things. And so there's a little bit of a tension. I mean, there's a great literature. People like Philip Andrade, David Lopez-Salido, Francisco Loria have been trying to do inflation at risk using inflation distributions. And that's all about having lots of years, panels, and data, so you can have enough disasters and look at those probabilities. That's
Just
just the issue of that. Yeah.
Just to clarify, I was actually referring to the most recent levels of inflation. Because when we, for instance, look at the euro area, it was very low. And then when we see inflation levels going up, actually the disaster probability also goes up.
Sorry,
That's what I was referring to.
No, absolutely. But then, okay, but then one could be a little more ambitious and say, aha, look, here's another showing of how backward-looking markets are, which we may even say these numbers are, it takes inflation to actually rise for them to start expecting the tail risk probability. Maybe these are really another showing of some adaptive expectations now here at the tail, because you didn't see them really start panicking early on. It was only after inflation started coming. And moreover, Petra, imagine we look forward and we say, look, imagine inflation comes down precipitously in the next 6 months. They say, wow, not only they are adaptive, they look at the actual data for inflation. On top of it, they overreact. Look, they looked at 12 months of inflation, start predicting high inflation on average for 5 years, 10 years from now. Maybe it's that. Well, what we know, certainly from the behavioral literature on service expectations, is that both of the things are true. They're somewhat backward-looking expectations, overreactive, and it seems like markets aren't that much better than people in that sense. But again, I'm getting a little ahead of myself. I think in 2 years, we'll be able to do those pronouncements on these things. But that's not inconsistent, certainly, with what I showed you.
Perfect. Okay, thank you very much. We are right on the money for the 15 extra minutes of discussion that we usually drip into. Let me again thank Ricardo for his wonderful talk. It turned out, I think, there was a lot of communication in it, even if it's not explicitly about communication. So thank you for that. To everybody else, thank you for coming. We will meet again in May, and the details of that will be sent out. But for now, on behalf of everyone in the audience, I'm going to give the clapping so that I can try and reflect our joy and enthusiasm for what you've presented. And we look forward to working with this data once it's available.
Thank you all. Thank you.
Thank you.